Hello everyone. Thank you for joining us today for the webinar on cashless transactions. I'm your host Ashika and this webinar is powered by Zoho Books, cloud-based, GST compliant accounting software. Before we begin, please note that if you have any questions throughout this session, you can feel free to type them out in the chat box in the GoToWebinar screen. I also have a team of panelists here who will answer your questions as we proceed with the presentation. Also, after this session, we will send you a recording of the webinar. Today we are going to discuss the impact of cashless transactions on small and medium businesses. This session is divided into three main parts. First, we'll discuss the traditional payment methods and the hassles involved. Then the different modes and processes involved in cashless transactions. And finally, the components of cashless transactions, merchant discount rate and chargeback. Traditional payment methods. As a business owner, you're likely to accept cash payments from your customers at times. At some point, either you or your customers would have faced some inconveniences from cash transactions. Now let's assume you accept only cash payments from your customers. Your situation would get much tougher in the long run. Most small business owners prefer cash payments, and accepting cash payments gives the business owner immediate access to money. In other words, instant gratification. However, they often tend to overlook the problems faced in accepting cash payments. Now let's check out a few possible hassles that the business owner is likely to face. For starters, cash payments are pretty hard to track. And as a business owner, customer satisfaction is your main goal. This is because you want your customers to have a great experience and to keep coming back to do business with you. But processing the customer payments can become an arduous and time-consuming process. And in most cases, this is because the payment options you've offered are more convenient for you than your customers. Now, most customers prefer choosing the payment method that is convenient for them. And customers these days are comfortable with going cashless. So if you don't offer cashless payments, some other business will, and your customer retention might suffer because of this. Besides, customers are likely to buy more when you accept cashless payments. Now, these are a few reasons why most business owners are moving towards cashless payment modes. It's safe to say that cashless transactions have revolutionized the financial outlook of India. The number of people using mobile phones to make payments instead of opting for the traditional modes of payment has increased tremendously since demonetization. Now, when the business operations of most businesses came to a standstill during demonetization, the businesses that had shifted to cashless transactions managed to curb their losses. Adding online payments to your options gives your customers the flexibility to pay through the option that is most convenient for them. Business owners and consumers can both benefit from digital payment modes in various ways, which we'll talk about in a moment. Now let's look at the different modes of online payment. Other than credit and debit cards, here are a few payment modes that are widely utilized in India. E-wallets. E-wallets are a popular mode of online payment, with Paytm and MobiKwik being the most widely used providers. The user has to register the mobile number with the app and link their credit or debit cards to make payments. Users should also provide their KYC details to make payments through digital wallets. KYC is a verification process stipulated by the RBI, which requires companies to collect information from customers, including their identification details and biometrics. E-wallets are convenient and they can be used in many places that debit and credit cards can't, as not a lot of small businesses invest in card machines. E-wallets, along with regularly offering discounts to users for making payments using them, they also have the advantage of being convenient and secure. However, the number of business owners accepting payments through digital wallets is limited, and certain transactions are likely to attract transaction fees. Mobile banking applications. Most of the larger banks offer banking apps with which business owners can transfer funds between their bank accounts instantly. They can also view their account balance and transaction history at any time. Now let's take a look at the pros and cons of mobile banking applications. Mobile banking services offered by banks are free of charge, and they're comparatively secure because the account information and number are not completely displayed. You can access these services through multiple channels like SMS, mobile apps, and web based software. However, mobile users are especially susceptible to a phishing like scam called smishing. It happens when a mobile banking user receives a fake text message asking for bank account details from a hacker posing as a financial institution. UPI, Unified Payments Interface System. This system enables instant transfer of funds between bank accounts. Users can send and receive funds once they provide bank details like their account number, IFSC code, and mobile number. Moving on to the pros and cons of UPI. On the whole, the user interface is simple and user-friendly. Fund transfers are secure, instantaneous, and can be made around the clock. The only con here is the transaction limit for payments, which is 1 lakh rupees. Bheem app. This newly launched app is used to transfer funds between bank accounts. It's reliable, links with most major Indian banks, and is secured with three-factor authentication. The user's mobile number or Aadhar card is used to make payments. And though the app works on the UPI platform, in case of this app, customers don't have to download mobile applications of multiple banks. So all they have to do is just install the Bheem app. One advantage of the Bheem app is that the user doesn't need to have net banking or mobile banking activated in their account to utilize it. The app has a user-friendly interface and provides secure scan and pay features to the users. The main limitation of the Bheem app is the transaction limit of Rs 20,000 and the daily limit of Rs 40,000. Aadhar Payment App. This app was launched in 2016 with the primary aim of boosting online payments in the country. It allows users to make offline payments and fund transfers between banks using their biometrics and Aadhar card details for authentication. It's not mandatory to own credit or debit cards to make payments through this app. The user only needs an Aadhar card and bank account to make payments. However, most retailers are yet to avail Aadhar biometric readers to accept payments through this app. Small business owners might not want to invest in biometric readers if they already have a point of sale machine installed. So those are a few examples of cashless payment modes. Now here are some advantages of choosing cashless transactions. Convenience. The most basic benefit of digital payments is that they make it easier to send and receive payments. Online payments rule out the need to carry cash and cards, and they also save time as business owners and customers no longer have to queue up for ATM services. Payment apps also help you keep track of your incoming and outgoing funds, which comes in handy while filing tax returns. They're secure. Digital payment modes are made secure with varying levels of encryption and data authentication. Most payment modes have enabled TFA to add an extra layer of security. Also, it's always easier and safer to carry a smartphone rather than carrying wads of cash. Discounts. To boost the move towards a cashless economy, the government has decided to offer incentives and discounts for making online payments. The government is now providing waivers on cashless transactions utilized for service tax payments, purchase of fuel, train tickets, highway toll tickets, and insurance schemes. Now, many business owners have adapted to digital payment modes, with many others coming forward with interest in moving towards a cashless economy. If you're one of those business owners, there are certain components of cashless transactions that you should know about. And in this webinar, we'll talk about chargebacks and merchant discount rate. So first, what is a chargeback? A chargeback is a transaction where funds are transferred by an issuing bank from the merchant's account to the customer's account. A chargeback is initiated when a customer escalates a dispute against the merchant. Chargebacks are often encountered by e-commerce merchants who should be aware of the different types of chargebacks and how to prevent them from negatively impacting the business. And chargebacks come in two types. Card present transaction. Now these are transactions where the customer is physically present during the credit or debit card payment. And these are the everyday transactions where you walk into your local grocery store and pay for your items with your card. Card not present transaction. These are transactions where the payment is made through the card, but the card holder is not physically present to provide the card for the merchant's reference at the time of ordering. Now, this makes it harder for the merchant to verify if the transaction is authorized by the cardholder. Most online payment, mail order, telephone order, and fax order transactions come under this category. And though card not present transactions are the most convenient for both customers and merchants, the possibility of fraud is higher than the card present transactions. Now, these are situations that lead to chargebacks, and we'll see each of them in detail. Shipping, quality, and refund issues. When a customer is unhappy with a product or service, for instance, if defective goods are shipped by the merchant, then the customer is likely to file a chargeback. When the customer fails to receive a product or service, or when the customer initiates a refund after returning the product but fails to receive the refund amount, the customer is very likely to file a chargeback against the merchant. Credit card issues. Unauthorized credit card transactions. Now, this is the most common cause for chargebacks, and these chargebacks are often filed when the card is used illegally, without proper authorization, and in case of card not present transactions, the chargebacks is seldom won by merchants. Invalid credit cards and insufficient funds. Chargebacks can be filed if the system fails to authenticate the credit card's account number, like expired authorization, or if the cardholder has insufficient funds for a transaction. Technical errors. Duplicate billing. When a customer is charged twice for a single transaction by the merchant, or when the customer ends up pressing the pay amount or pay button multiple times, when the customer is billed an incorrect amount by the merchant. Bank processing errors. Chargebacks can be filed if a transaction is declined by the issuing bank, but the customer's account is still charged. So if you have an increase in chargebacks, your business is likely to incur heavy losses and the reputation of your firm might be at stake. There are other consequences as well. Merchants are heavily penalized for chargebacks, and chargebacks are expensive, and the entire cost reflects on the amount charged to the merchant. Now that you know how chargebacks can affect your business, it's important to be aware of the chargeback process and the steps to be taken from your side if a chargeback is filed by a customer. It all begins when a customer files a complaint with the issuing bank regarding an incorrect transaction. The issuing bank checks the authenticity of the complaint. In case the complaint is proved invalid, the customer will be charged a processing fee and the complaint will be dismissed. If the complaint is valid, the issuing bank initiates the chargeback process where the amount will be obtained from the merchant's acquiring bank, and this corresponding amount will be credited to the customer's account. The merchant receives a notification regarding the chargeback once the acquiring bank checks the validity of the complaint. If the chargeback is invalid, the request is declined and a confirmation of the same is sent to the acquiring bank. If the chargeback is found to be valid, the chargeback amount is deducted from the merchant's account and the merchant will be notified regarding the deduction. The merchant can choose to dispute the chargeback in case of processing errors, and they will need to present proof to aid their case. If the proof is deemed unsatisfactory, the chargeback amount will be credited to the customer's account. If the proof is deemed valid and satisfactory, the chargeback is denied and the customer will be charged for the processing fee. The chargeback process is tedious and is likely to last for weeks. This is why it's advisable to prevent chargebacks in the first place. For starters, it would help to be an honest merchant selling good quality goods on time and providing proper customer support. And here are a few other tips to prevent chargebacks. Provide detailed information to your customers. If you're selling your merchandise online, make sure you provide accurate images and descriptions of the products you've listed. Include your contact information and your return and shipping policy. That will help your customers have a better understanding of your policies and allow them to contact you in case of any complaint instead of raising a chargeback request. Customers are likely to request chargebacks when they fail to recognize the charge on the card statement. So make sure that you list your firm's name and a description of the transaction to prevent unnecessary chargebacks. Email your customers for confirmation. When you're sending confirmation emails to your customers, make sure you include the shipping address and the invoice of the order. In case the shipping address and the billing address are different, verify the card and customer details before initiating the sale. Keep an eye out for these transactions. They are possible red flags for fraudulent chargebacks. Multiple orders for expensive products, unusual bulk orders and multiple orders within a short span of time, multiple orders with the same delivery address, though the cards used for the orders are different. So that's all about chargebacks. Let's move on to MDR. To understand the concept of MDR, let's take the example of a merchant named David. David has been steering his business venture pretty well for a first-timer. On hearing about the advantages of cashless transactions, he decides to accept card and online payments from his customers. He reads upon online payments and stumbles upon the term MDR. Now, David is not very familiar with this term MDR and he wants to know more about it. What is MDR? It's basically a fee that a merchant is charged by their issuing bank for accepting payments from their customers through debit and credit cards. MDR compensates the bank issuing the card, the bank which installs the point of sale terminal, network providers like MasterCard, and payment gateways for their services. MDR charges are shared equally between these parties and the charges are expressed as a percentage of the transaction amount. Now, David wondered why he hadn't learned about MDR with respect to cashless transactions earlier. The answer to his question is simple. Until recently, MDR was passed on to the customers by the merchants, which increased the number of cash payments as customers tried to avoid incurring extra charges in the name of MDR. Another reason was the limited number of point-of-sale terminals. During the pre-demonetization days, there were 700 million debit cards in India, but there were only 2.5 million point-of-sale machines for these cards, and they were highly concentrated in the metropolitan cities. To give cashless transactions a push, issuing banks had to increase the number of cards and point-of-sale terminals in circulation, and they had to actively get more merchants to install the terminals. But this alone didn't bring about the expected change. On one hand, issuing banks faced several challenges in getting small merchants to install point-of-sale machines. The major challenge was that cash transactions entailed no extra cost to them, while card payments did. On the other hand, banks were willing to increase the POS coverage only if the MDR share was profitable to them. In a bid to address these issues, the RBI has decided to allow issuing banks to charge large businesses a higher MDR fee, while small businesses are charged comparatively lesser. Now, how do you decide if your business is considered small scale or not? The RBI has a clear threshold for that. Businesses with a turnover of up to Rs 20 lakhs in the previous year are considered small businesses, and these business owners should pay a maximum MDR of 0.4% of the bill value. Businesses with turnover greater than Rs 20 lakhs in the previous year are considered medium and large businesses, and these business owners should pay 0.9% of the bill value. Also, RBI has set an MDR limit at Rs 200 per bill for small business owners and Rs 1000 for the others. So those figures were for card payments. A different set of rules are mandated for QR or quick response based payments. For small businesses, the MDR will be 0.3% or Rs 200 per transaction, whichever is lower. As for the rest, the MDR will be 0.8% or Rs 1000 of the transaction value, whichever is lower. The government will bear MDR charges on transactions up to Rs 2000 made through debit cards, Bhim app, UPI, or Aadhar-enabled payment systems. Now, what should I take away from this and what impact would MDR have on my business, thought David. David now knows that he can't pass on the MDR charges to his customers because of the rules laid down by the RBI. His MDR charges will turn out to be a tad bit expensive in case of transactions of lesser value. However, for transactions of higher value, the MDR charges are likely to be relatively inexpensive. With the increase in online payments, there's been a decrease in the long queues to make utility bill payments, and the need to be physically present at showrooms and service centers to pay or recharge DTH and mobile services is long gone. Business owners and customers have taken to digital payment methods for all sorts of transactions. Since a major part of the Indian population is not well versed in digital payment modes, there is a certain amount of reluctance in utilizing digital payment modes. As digital payment technology becomes more common and familiar, it will get easier for merchants and customers to adopt the new payment methods and use them successfully. Demonetization has given the much required push to cashless transactions. And though digital payments have reduced a tad bit after demonetization, they're still up by 50% compared to their numbers during the pre demonetization days. To wrap it up, it has come to a point where both customers and business owners are actually considering digital payment modes. Though the growth is gradual, there is a visible coexistence of cash and digital modes of payment in the Indian economy. With that, we come to the end of this webinar. We hope you enjoyed this webinar and found it productive. You can find more webinars under GST resources on the Zoho Books website. And in case of any queries, feel free to contact us at support@zohobooks.com. Thank you.